Opportunity and risk in a new insurance market. While relatively small in comparison to the major Latin American insurance market, Costa Rica is the largest insurance market in Central America, excluding Panama. The country also has a uniquely diversified economy for the region, has experienced rapid annual growth in the insurance market between 15% and 46% annual growth in recent years, and still has a relatively low insurance penetration rate, 2.6%. Prior to 2008, however, the country had maintained a government monopoly over the insurance and reinsurance market through the Instituto Nacional de Seguros (INS). In August 2008, new legislation was passed in Costa Rica and signed into law by President Dr. Oscar Arias Sanchez that ended the more than 80-year-old state-sponsored monopoly over the Costa Rican reinsurance business. While the new ley Reguladora del Mercado de Seguros opened the insurance market to private competition from domestic companies and foreign companies with local branches, it also contained prohibition and increased penalties that may come as a surprise to any foreign reinsurers that do not carefully review their activities in connection with any Costa Rican risk. Market trend and characteristic. Due to dependence upon the United States and European economies, Costa Rica's insurance market growth is expected to remain flat for 2009. This plateau is expected to be only temporary, however, and come on the heels of 28% growth in 2007 and double-digit growth in the prior years. Furthermore, Fitch predicts continued growth in both the general economy and in the insurance market specifically well into the future. Fitch based its recent opinion of the Costa Rican economy of the nation's high per capita income, strong governance indicators, net external creditor position, improved public finances, and relatively diverse economy, and the full implementation of the Dominican Republic Central America Free Trade Agreement and its accompanying legislation, which should help sustain this trend over the medium to long term. As to Costa Rica's insurance market, Fitch expects continued premium growth and increased market penetration as private companies enter the market and increase price competition. Not surprisingly, these economic indicators and the opening of the reinsurance market to private and foreign competition has led to significant, if cautious, interest in the past year. Seguros del Magisterio, a Costa Rican company that formerly provided services exclusively to the nation teachers under an exemption to the government monopoly, became the first private competitor in February 2009. Asegurada Mundial, a Panamanian company, received initial authorization in July 2009. A number of other companies, including Qualitas of Mexico and Alico of Panama, are also in the process of obtaining authorization. Recent regulatory development. Under the new law enacted in August 2008, the interim reinsurance regulator was charged with establishing an insurance regulatory authority and implementing the other mandates of the new law. While certain regulations governing the market have still not been finalized as of the time of this writing, the basic tenet of the regulatory structure, such as authorization and solvency requirements, are already in place in the form of the statute itself and several set of regulations issued since the opening. Companies seeking to sell personal line or general insurance will be required to have minimum operating capital of $3 million. Companies wishing to sell both will be required to have minimum capital of $7 million, and companies wishing to operate as reinsurers will be required to have minimum capital of $10 million. While the minimum capital requirement contained in the new law are far lower than those contemplated in earlier draft, which range from $10 million to $40 million, they remain fairly high in comparison to many other developing and established insurance markets. In addition to opening the Costa Rican insurance market to private competition, however, the new statute and regulation also establish new prohibition against insurance activities in the jurisdiction by non-registered foreign insurers and reinsurers and created a new framework of far more serious penalties for violation of this prohibition. Given this new provision and the newly created incentive for the INS to report and the regulators to investigate any violation, the risk of adverse enforcement action has risen significantly with the new legislation. Potential fines for illegal sale of foreign insurance, the definition of which include marketing of foreign policies by phone, email, or facsimile, appear to range as high as $360,000 per violation under the new insurance laws. In this regard, it should be noted that while the old law was essentially a non-solicitation stated, the new law's definition of insurance activities that non-registered insurers and reinsurers are prohibited from undertaking in the jurisdiction isn't limited to sales solicitation. To the contrary, the definition appears broad enough to implicate any sort of claim investigation or adjusting activities, whether conducted directly or through a local agent. Therefore, while the statute doesn't prohibit Costa Rican persons and entities from seeking insurance outside of the jurisdiction, an insurer holding such a policy would be left with little ability to investigate or adjust any potential loss. Indeed, the interim regulator recently issued a technical note providing further guidance as to several regulatory issues of significant importance to foreign reinsurance companies. The Costa Rican law applies to any person involved in the development of realization of any insurance activities, whether in the nature of insurance, reinsurance, intermediary, or auxiliary services. The law applies to such activity whether it occurs within the Costa Rican territory or from abroad directed toward Costa Rica, and whether such activities are conducted directly or through intermediaries. The public offering of insurance services, which is prohibited in the absence of proper authorization or an applicable exemption, includes any activity that procures the sale of an insurance policy or provides specific or concrete information concerning a particular insurance policy.